Your brain is hardwired to keep you poor, fueled by survival mechanisms from the Stone Age. Everything you have been taught about money is likely just a byproduct of that outdated evolution. If wealth were just a math problem, everyone with a calculator would be a millionaire today. Why do brilliant people consistently make such incredibly stupid financial decisions despite knowing better? Your financial mindset is like a computer's operating system running outdated software on modern hardware. I am Nick, and I am here to help you upgrade that prehistoric programming once and for all. We are going to explore 12 financial principles designed to rewrite your internal wealth code. Most people are stuck on a hedonic treadmill, running faster without ever actually moving forward. We must look past the visible toys to understand the true power of invisible wealth. Your savings rate matters far more than your ability to pick the next hot stock. Many investors fail because they view market fluctuations as a penalty rather than a volatility fee. We will decode why simple index funds often outperform the most sophisticated Wall Street strategies. Understanding compounding is vital, but mastering your own psychological programming is the ultimate key. These principles aren't just about spreadsheets. They're about the mental models that govern your life. We are diving deep into the psychology of money to expose the myths holding you back. What if the real secret to wealth was never about the numbers on the screen? Together, we will dismantle the barriers between your current income and your future freedom. Prepare to shift your perspective and embrace a new way of thinking about your capital. But to fix the system, we first have to admit that the system is broken. Let's begin the process of identifying the cracks in your current financial foundation. We are told to treat money like a spreadsheet, that our bank accounts resemble a therapist's notebook. To fix your wealth, you must first address the lie at the heart of the financial industry. Most advice assumes you are a logical robot, capable of following perfect math without any hesitation. If finance were truly just math, everyone with a simple calculator would already be a millionaire. Why does a sudden stock market dip feel like a physical threat to your very survival? It is because your money decisions are deeply emotional long before they ever become mathematical. Standard advice ignores the psychological programming that dictates how you actually spend and save every day. Trying to manage money with only logic is like driving a car while ignoring the engine's heat. You might think you're rational, but your brain is busy running software from a prehistoric era. Your past experiences create an invisible script that controls your financial hand more than any spreadsheet. When you chase the latest trend, you are often trapped on a relentless hedonic treadmill of consumption. This constant need for more makes maintaining a high savings rate feel like an impossible chore. We focus on index funds and compounding, yet we ignore the humans actually making the trades. Successful compounding requires a temperament that most logical models simply fail to account for properly. Every investor must eventually pay a volatility fee, which is measured in stress rather than dollars. True success comes from building invisible wealth that exists far beyond the reach of public display. Your emotions act as the invisible hand guiding your mouse when you click the sell button. Logic says to hold, but your ancient survival instincts scream at you to run for cover. Understanding this internal conflict is the only way to finally break free from your old patterns. You are not a broken machine. You are a human with deeply ingrained emotional responses to risk. Stop trying to delete your feelings and start learning how to navigate them with actual intention. Once you realize you aren't a robot, you can finally stop feeling like a total failure. Accepting your humanity is the first real step toward mastering the complex world of personal finance. You can now begin to build a system that works with your nature instead of against it. Let's move past the math and start exploring the hidden drivers behind your every financial move. Exactly 0.00001% of the world's economic history is what you've actually seen and experienced yourself. This brings us to lesson 1. The reason you feel the way you do is your timeline S product. That tiny sliver of personal history controls 80% of how you think money actually works today. Your financial worldview is like a pair of glasses you were forced to wear at birth. You don't even realize they're tinted, yet they dictate every major investment decision you make. This psychological programming starts long before you open your first bank account or buy a stock. Consider those who lived through the Great Depression and watched their entire world collapse overnight. These survivors often hoard cash because their instinctual behaviors were forged in a time of scarcity. They aren't being irrational. They are simply reacting to a reality you never had to face. Contrast them with the generation that came of age during the explosive dot-com boom of the 90s. Those individuals tend to chase aggressive growth stocks, fueled by the optimism of their formative years. Millions of years of evolution still drive us to follow the crowd to ensure our survival. This herd instinct is why we often pay a high volatility fee for our emotional reactions. Look at the recent GameStop frenzy, where retail investors piled in as the price hit $300. Are you truly a strategic investor, or are you just a survivor of the year you were born? Your personal savings rate often depends more on your childhood environment than your current math skills. We get stuck on the hedonic treadmill, chasing more because our programming demands constant upward movement. Compounding works best when we step back and let the logic of index funds do the work. True invisible wealth isn't found in a meme stock rally, but in the discipline of your habits. Why does your grandfather hoard cash while your brother desperately chases the next big meme stocks? Neither is crazy. They are both just operating from a different set of narrow economic experiences. Your perspective is just a tiny fragment of the massive complex puzzle of global financial history. Your gut reactions to market dips are often just echoes of your family's financial struggles. We mistakenly believe our logic drives us, but our history is actually holding the steering wheel. When we understand that our instincts are just survival mechanisms, we can finally reclaim our logic. Breaking free from this cycle requires recognizing that your personal experience is not the universal truth. Once you strip away the emotional bias, the spreadsheets finally begin to make sense again. But when we realize that nobody is crazy, we can finally start to be objective. To understand why we fail with money, we must first look deep into our ancient past. Our ancestors survived the savannah not by being the strongest, but by staying close to the tribe. This deep psychological programming ensured that wandering alone usually meant becoming a predator's next easy meal. For millions of years, following the crowd was the most reliable insurance policy for staying alive. Evolution rewarded those who mirrored the group, etching the herd instinct into our very genetic code. However, the survival mechanisms that saved our ancestors are now sabotaging our modern financial lives. What was once a life-saving instinct has become a dangerous liability in the world of investing. In the stock market, the urge to follow the crowd often leads directly toward financial disaster. When everyone else is buying, your brain screams that it is finally safe to join in. When the herd panics and runs, your ancient survival software demands that you run away too. This biological impulse turns the natural volatility fee of the market into an unbearable emotional burden. We end up buying at the peak of excitement and selling at the depth of despair. Your psychological programming is trying to protect you, but it is actually draining your bank account. Success in wealth creation requires us to fight against millions of years of ingrained human behavior. True compounding happens when you have the courage to stand still while everyone else is running. Utilizing index funds allows us to bypass the noise of the crowd and focus on growth. Building invisible wealth requires a level of discipline that our ancestors never had to maintain. We often follow the herd onto a hedonic treadmill, chasing status symbols instead of lasting security. A high savings rate is your best defense against the impulsive whims of the collective group. By recognizing these biological triggers, we can finally begin to make truly objective financial decisions. Understanding your hardware is the first step toward upgrading your entire financial operating system. Lesson 2 asks a dangerous question. How much is enough for you to be truly happy? Without an answer, you are running a race that has absolutely no finish line in sight. Even if you understand your personal history, you can still get trapped by your own future. Your brain is constantly scanning for more, ignoring the abundance you have already managed to build. This relentless drive for expansion is part of your deepest, most primal psychological programming from birth. Chasing a higher financial ceiling without a plan is like trying to fill a broken bucket. We often mistake a bigger paycheck for progress, but the goalposts are always moving further away. Enter the hedonic treadmill, a cycle where your desires always rise to meet your new income. Think back to your last big raise and how exciting that extra money felt at first. Research shows that a major promotion typically feels completely normal within just 6 short months. That life-changing salary quickly becomes the new baseline, leaving you hungry for the next big jump. You start spending more to keep up with a lifestyle that once seemed like a dream. This is how wealthy people end up broke, risking everything they have for things they don't. They ignore the power of compounding by constantly draining their accounts to fund a fleeting image. Instead of building invisible wealth, They choose visible symbols that offer no long-term financial security. True wealth is found in the things you don't see, like a high and consistent savings rate. It is the quiet accumulation of assets in index funds that grow while you are asleep. Successful investors view market dips as a volatility fee rather than a reason to panic and sell. But the treadmill keeps spinning, whispering that you need just a little bit more to be safe. Why does that 20% raise feel like just enough for only 6 months of your life? You are risking your peace of mind for extra digits that will never satisfy your soul's hunger. If you don't define your enough, you will spend your entire life chasing a ghost of satisfaction. The most logical spreadsheet fails when it meets the bottomless pit of human greed and comparison. To win the game, you must stop playing by the rules of everyone else around you. The treadmill never stops moving forward until you decide to finally step off and be still. Mike Tyson once famously said that everyone has a plan until they finally get punched in the face. Lesson 4 is about learning how to take that punch without losing your entire financial future. Life rarely cares about your enough point if you are not prepared for the inevitable chaos ahead. Is your current financial plan built for a perfect world or the unpredictable reality we actually inhabit? We often treat our wealth like a static spreadsheet, forgetting that the real world is constantly moving. Every financial strategy will eventually face a disruption that tests the strength of your psychological programming. What happens when the unprecedented happens for the third time in less than a single decade? Without a buffer, you are essentially gambling that tomorrow will look exactly like yesterday's comfortable routine. The inflation monster is constantly working in the background to erode the purchasing power of your savings. Keeping cash in a basic savings account means watching its value slowly disappear over many years. Inflation is the invisible tax that punishes those who simply hoard cash without a strategic purpose. An emergency fund isn't just stagnant cash. It is a vital shield against the punches of reality. This reserve allows you to maintain your savings rate even when the world outside feels completely broken. When a crisis strikes, your invisible wealth becomes the only thing standing between stability and total ruin. Compounding only works if you can leave your investments alone during the most volatile market cycles. If you lack a safety net, you might be forced to pay a heavy volatility fee. Selling your index funds during a downturn is a catastrophic mistake caused by a lack of preparation. We must rewire our brains to view cash reserves as an insurance policy for our long-term goals. This connects back to our instinctual behaviors where survival always takes priority over long-term growth. High energy is required now because this is your wake-up call to protect your financial legacy. Stepping off the hedonic treadmill requires more than just willpower. It requires a functional safety net. Your plan must survive the unexpected, or it isn't really a plan at all, just a wish. Resilience is built in the quiet moments before the storm actually arrives at your front door. Having the liquidity to act while others panic is the ultimate psychological advantage in any market. We must prepare for the punch so we can stay standing when everyone else is falling. The biggest risk isn't the market itself, but being forced to sell when you are at your weakest. If surviving the punch was about resilience, then mastering wealth is about what you do while waiting. What if I told you that being a financial genius has nothing to do with being smart? Real success in this game actually depends on your ability to be incredibly and consistently bored. Professional pilots often describe their high-stakes career as hours of boredom punctuated by moments of sheer terror. They spend most of their time monitoring systems and maintaining a steady, average course through the clouds. In the cockpit, the goal is never excitement. It is the discipline of keeping everything perfectly routine. Investing follows this exact same rhythm, requiring you to ignore the noise while the world screams. We define a financial genius as someone who does the average thing while everyone else is panicking. When the market swings wildly, most people feel a desperate need to do something to fix it. Your psychological programming kicks in, demanding action when the best move is often to just stand still. Embracing simple index funds might feel dull, but it is the ultimate way to capture market growth. Consider the occasional market crash as a volatility fee you must pay for long-term compounding rewards. This fee isn't a mistake. It is the price of admission for building lasting, invisible wealth. Many investors ruin their progress by trying to outsmart a system that rewards patience over frantic activity. They chase the next big trend, falling right back onto the exhausting cycle of the hedonic treadmill. True genius is resisting that urge and sticking to your boring, predetermined plan through every storm. Maintaining an average course doesn't sound sexy, but it allows compounding to perform its quiet magic. While others are losing their minds in their shirts, the boring investor is simply staying the course. Your savings rate matters more than your ability to predict the next big crash or market boom. Can you handle the boredom of wealth, or will you chase excitement at the cost of your future? Success isn't about those moments of terror. It's about how you handle the long hours of boredom. Because if all this boredom doesn't buy you something valuable, what exactly is the point of investing? Would you rather have $1 million in no time or enough to never ask permission again? Lesson 6 explores the true currency of life, shifting focus from bank balances to total personal autonomy. The ultimate form of wealth is the simple, powerful ability to wake up and control your time. We often mistake luxury for wealth, forgetting that invisible wealth is actually the freedom to do nothing. Consider this question deeply. Who truly owns your Tuesday mornings while you are chasing that next promotion? Many high-earning professionals find themselves trapped in golden handcuffs, trading their most precious years for higher salaries. Maximizing your income without gaining freedom is like upgrading your jail cell from iron bars to gold. Are your golden handcuffs getting tighter every single time you receive a significant and well-deserved annual raise? This cycle is fueled by the hedonic treadmill, where higher earnings only lead to more expensive desires. Our psychological programming often convinces us that status matters more than the actual hours we spend living. A high savings rate isn't just about the math. It is the down payment on your future independence. When your time starts compounding, you begin to see life through a lens of possibilities instead of obligations. Even stable investments like index funds serve a higher purpose than just growing a large pile of cash. Think of market fluctuations not as a loss, but as the volatility fee for eventually buying back time. True freedom is defined as the ultimate form of wealth, far outweighing any number on a spreadsheet. Every financial decision you make is a choice between a more impressive lifestyle or more personal freedom. Remember our earlier discussion on enough, because knowing your limit is the only way to break this cycle. Having total control over what you do and who you do it with is the highest dividend money pays. Remember, your life is too valuable to trade your ultimate freedom for a shimmering gold-plated cage. But freedom isn't just a mindset. It's a math problem that most people get backwards. I'm going to show you how a teacher earning $50,000 can end up richer than a lawyer. Most people focus on the size of the check, but that's a dangerous psychological trap. Meet a teacher earning $50,000 a year who religiously saves 20% of her income. Now, compare her to a high-powered lawyer pulling in a staggering $200,000 annually. While the lawyer seems wealthy, he only manages to tuck away 5% of his earnings. Despite the income gap, the teacher's higher savings rate builds a massive lead over the long run. We've been conditioned to believe that wealth is about how much money you bring home. In reality, wealth is mathematically determined more by your savings rate than by your total income. Think of your income as fuel, but your savings rate as your engine's true efficiency. A slow car with a great engine will eventually beat a Ferrari that is leaking gas. Every dollar you spend represents more than just a simple exchange for a temporary product. Each spent dollar is a permanent loss of the compounding growth that money could have earned. When you buy things to impress others, you are essentially trading your future freedom for status. Compounding works silently in the background, but only for the dollars you actually decide to keep. The lawyer often falls victim to the hedonic treadmill, spending more as his income rises. His psychological programming demands a lifestyle that mirrors his professional status in the world. Meanwhile, the teacher builds invisible wealth by quietly investing her modest surplus into index funds. She avoids the volatility fee of emotional spending by sticking to a disciplined financial plan. Are you working for your money, or is your money finally starting to work for you? Is that high salary truly worth it if it leaves you with nothing at the month's end? The logical investor understands that true wealth is the part of the iceberg under the water. It is the money you don't spend that eventually buys you the freedom to walk away. Wealth isn't about the car you drive. It's about the options you have on a Tuesday. Focus on the gap between what you earn and what you spend to escape the trap. Income is what you show the world. Savings is what you show your future self. Think about the last $20 you spent on a whim at the local coffee shop. It felt like a small transaction, barely a blip on your monthly bank statement radar. But your psychological programming is lying to you about the true cost of that simple purchase. In reality, every single dollar you spend today is a thief stealing from your future self. That $20 bill isn't just paper. It is the seed of a massive future oak tree. When you spend it now, you are essentially chopping down that tree before it even sprouts. This is the hidden trap of the hedonic treadmill, where instant gratification masks a massive loss. We focus on the product in our hand rather than the compounding wealth slipping through fingers. Every dollar spent represents the loss of compound growth that money could have earned over time. Imagine that single dollar transforming into 10, then 50, then hundreds of dollars over your lifetime. By choosing to spend today, you are paying a heavy price in potential invisible wealth tomorrow. Your savings rate isn't just a number. It is the heartbeat of your long-term financial freedom. Most people see a price tag and only think about the immediate impact on their wallet. True investors look at that same price tag and see the thousands of dollars they are sacrificing. This perspective shift is essential for anyone hoping to master the complex art of index funds. It requires fighting the urge to show the world your status through temporary, depreciating consumer goods. Instead, you must learn to value the silent growing power of money left untouched to compound. Think of every purchase as a trade-off between a moment of joy and years of liberty. Are you willing to pay the volatility fee of the market to reach that ultimate freedom? Or will you keep fueling the treadmill until there is nothing left for your future self? Every dollar is a soldier, and every time you spend one, you lose a loyal combatant. To build real wealth, you must stop viewing money as something to be traded for things. Start seeing money as a living engine of growth that multiplies while you are fast asleep. This is the psychological barrier that separates the truly wealthy from those who just look rich. Every choice to save is an investment in the version of you that hasn't arrived yet. Once you have mastered the art of saving, the next step is deceptively simple. Do absolutely nothing. If you invest for a single day, your chances of winning are basically a coin flip. Historical data proves that one-day market bets result in a gain only about 50% of the time. Why do we obsess over the right time to buy when time spent is what actually matters? Staying invested for just 1 year increases your probability of seeing positive returns to 66%. Think of investing like planting an oak tree. Checking the roots every week will only kill it. If you can endure the market for 10 years, history pushes your success rate to 88%. This is where the boredom of wealth creation becomes your most powerful psychological programming tool. Stretch your horizon to 20 years, and historical data shows positive returns in nearly every rolling period. At that point, the volatility fee you paid in stress finally buys you nearly guaranteed financial growth. Consider the unlucky soul who invested everything in 2007, right before the global financial crisis hit. Despite the catastrophic crash that followed, that same investor was actually ahead within just 10 years. Even the worst timing in history is eventually rescued by the relentless power of index funds compounding. Can you survive the small chance of a bad decade to reach the certainty of a lifetime? Our Stone Age brains scream for action, but the spreadsheets whisper that patience is the only path. This is how invisible wealth is built, not through brilliant trades, but through sheer, stubborn endurance. The math is clear. The longer you stay, the less the initial entry price actually matters. Stop looking at the daily noise and start looking at the decades where wealth truly lives. Remember, the market does not reward the smartest. It rewards those who are simply the most patient. Your future self is counting on you to stay seated while everyone else is running for the exits. Imagine an investor with the most unfortunate timing in the history of the stock market. Our protagonist decides to invest his life savings at the absolute peak of late 2007. Within months, the 2008 financial crisis strikes, sending the global economy into a massive tailspin. The psychological programming of fear kicks in as he watches his hard-earned money rapidly vanish. Most people around him are sprinting for the exits, desperate to save whatever remains of wealth. He faces the ultimate test of the volatility fee, the required price of admission for gains. Instead of succumbing to the panic, he chooses to ignore the terrifying headlines on the news. He resists the urge to jump off the hedonic treadmill and maintains his quiet, invisible wealth. Rather than selling his shares, he keeps his money in broad index funds and simply waits. He knows that compounding only works if you give the process enough time to actually happen. As the years roll by, the market begins its slow and agonizing crawl back towards stability. By staying invested, he avoids the fatal mistake of locking in his losses during the bottom. His strategy was simple: do nothing while the world felt like it was coming to an end. He focused on his savings rate, continuing to contribute even when the outlook seemed incredibly bleak. This stubborn refusal to sell allowed his portfolio to capture the recovery of the following decade. By 2017, exactly 10 years after his ill-timed entry, a startling realization finally became very clear. Even though he started at the worst possible moment, he had actually come out significantly ahead. His patience transformed a potential financial catastrophe into a masterclass in long-term wealth building and resilience. This story illustrates that the market rewards the most patient participants, not just the smartest ones. True financial freedom comes from understanding that the calendar is more powerful than any market chart. He did not need to predict the future. He just needed to survive the present chaos. Your ability to stay seated while everyone else runs is the ultimate competitive advantage in investing. But if staying put is the answer, why is everyone trying to sell you a complex shortcut? The investment industry has a secret. They need you to think this is hard to justify fees. They dress up simple math in expensive suits and complex jargon to keep you feeling confused. We are told that winning requires sophisticated strategies and constant monitoring of the global markets. It feels like a logical necessity to pay experts for their supposedly superior financial wisdom. However, the industry has a vested interest in making you believe success requires their constant intervention. They profit by selling complexity, even when that complexity actually works against your long-term goals. Think of active management, like paying a professional athlete to play a game for you. You expect them to dominate the field because of their specialized training and elite status. But here's the shocking truth that the big banks never want you to see. Professional fund managers fail to beat simple index funds approximately 85% of the time. Imagine hiring a pro who loses the majority of matches to a guy just standing still. Most actively managed funds fail to beat benchmark indices when you look at long time periods. They charge high fees for the privilege of underperforming a basic, low-cost basket of stocks. This is not just a minor slip. It is a systematic failure across the entire financial landscape. Simple investing strategies like low-cost index funds generally outperform the most sophisticated ones over decades. Index funds don't try to outsmart the market. They simply capture the market's natural growth. By choosing simplicity, you avoid the volatility fee and the high costs of frequent trading. Your psychological programming craves action, but your bank account thrives on boring, consistent compounding. The industry preys on our emotional need to feel like we are doing something productive. They turn the stock market into a high-stakes casino to keep your attention and your money. Why would you pay a professional to underperform a simple index that anyone can buy? Complexity is rarely a winning strategy. More often, it is just a very clever marketing tactic. Real wealth isn't built through frantic movement, but through the patient mastery of index funds. We must choose between the ego of active management and the quiet success of the index. The math is clear, yet our Stone Age brains still fall for the allure of complexity. Stop trying to beat the game and start owning the game through simple, diversified holdings. In the world of finance, you often get exactly what you do not pay for. The less you pay in fees, the more you keep for your own invisible wealth. Mastering this principle is the final step in rewiring your brain for true financial freedom. If simplicity is the ultimate advantage, we must ask why the financial industry demands such complexity. The investment industry thrives on the myth that wealth requires constant monitoring and high-level technical expertise. This psychological programming makes you feel small while they charge you for their supposedly superior wisdom. They use a complex language of jargon to build a wall between you and your own money. Beneath the expensive suits and polished charts lies a reality that the industry desperately wants to hide. Most active fund managers fail to beat the simple benchmark indices they are paid to outperform. You are essentially paying a high premium for results that are often worse than doing nothing at all. This invisible drain on your wealth is justified by tools designed to look more sophisticated than they are. They want you to believe that compounding is a secret ritual only the initiated can truly master. Your savings rate matters far more than the specific, complicated products they are trying to sell you. By complicating the process, they create a dependency that keeps their high management fees flowing every year. These fees act as a volatility fee on your future, eating away at your potential for freedom. The truth is that most professional managers struggle to keep pace with basic, low-cost index funds. They rely on your fear of the unknown to keep you trapped in their web of complexity. When you realize the system is rigged for their profit, you can finally take back your control. Success isn't about outsmarting the market. It's about ignoring the noise designed to distract you. The industry sells the idea of active management, but the math tells a much darker story. Over long time periods, the vast majority of these expensive funds underperform the very market they track. You are paying for the privilege of losing ground to an unmanaged list of top companies. This creates a massive gap between the wealth you see and the invisible wealth they take. Breaking free from this trap requires seeing through the jargon and returning to the fundamental basics. Your psychological programming has been hijacked by a machine built to keep you on the hedonic treadmill. Simple index funds are the ultimate hack against a system designed to keep you paying high fees. Once you stop paying for underperformance, your compounding can finally reach its full, untethered potential. You don't need a genius in a skyscraper to manage what you can automate yourself today. Warren Buffett isn't just a legendary investor. He is actually a world-class professional at simply waiting. While most people hunt for complex shortcuts, the secret to his success is deceptively simple. If you want to see what staying put looks like in reality, look at the Oracle of Omaha. Most investors overlook the fact that Warren Buffett actually began his financial journey at age 10. Imagine a child navigating the stock market while others were still playing with toys in the backyard. By the time he reached age 30, his disciplined approach had grown his net worth to $1 million. This sounds impressive, but it was merely the quiet beginning of a much larger, compounding story. For decades, he did not chase trends but instead let his capital sit and grow silently. Compounding is like a snowball rolling down a mountain, barely growing during those first 100 yards. Most people quit during this slow phase because they lack the patience to see the process through. Buffett understood that success requires rewiring your psychological programming to give the compounding math enough time. By the time he reached the age of 59, his net worth had climbed to $4 billion. 99% of his current massive wealth actually arrived well after his 50th birthday. Today, that mountain of wealth has reached a staggering peak nearing $150 billion. Is this incredible result a product of pure brilliance, or just 80 years of extreme patience? Could you start at age 10 and wait half a century before seeing the real payoff? The difference between a millionaire and a billionaire is often just the length of their personal timeline. His strategy proves that wealth building is less about intelligence and more about escaping the hedonic treadmill. You don't need to be a genius if you have the discipline to let compounding do the work. The math of consistency is incredibly boring until the very moment it finally becomes miraculous. Most of the rich people you see are actually poor, while the truly wealthy remain almost entirely invisible. Staying patient feels impossible because our psychological programming demands that others witness our grand success right now. We often mistake a high-end lifestyle for success, but being rich simply means spending money on expensive things. Consider the sleek Tesla you see humming down the street, designed to turn heads and signal social status. Most people buy luxury items like a Tesla to impress others, yet observers rarely look at the driver. Instead of admiring you, they are simply imagining themselves in the seat of that beautiful, expensive machine. Looking rich is like wearing a heavy costume that looks great to the audience, but is exhausting to carry. Every dollar spent on that status-seeking costume is a dollar removed from the foundation of your financial security. While richness is loud and visible, true wealth is defined by the money you haven't actually spent. Wealth is the invisible wealth tucked away in bank accounts, quietly accumulating value while the world stays unaware. This hidden stash provides the ultimate luxury of security and the freedom to choose your own life path. We often get trapped on a hedonic treadmill, running faster to buy more things that never truly satisfy. Our ancient brain craves social validation, pushing us to prioritize immediate appearance over long-term financial stability. Instead of buying status, the wealthy let their money grow quietly through index funds and consistent compounding. They understand that market dips are just a volatility fee required for the privilege of seeing long-term gains. Your freedom is actually a math problem, determined by your savings rate, not by your outward appearance. Remember the humble teacher who built a fortune while the flashy lawyer struggled with mounting invisible debts? Are you buying that luxury car to actually get somewhere, or just to be someone in others' eyes? When you see a $100,000 car, do you see wealth, or do you see money that is gone? The hard truth is that every time you see a fancy car, you only know they have less money. True wealth is what you do not see. It is the cars not purchased and the diamonds not bought. We must rewire our brains to value the options that unspent money provides over the objects themselves. Mastering this mindset shift is the only way to escape the exhausting cycle of performing for complete strangers. Always remember this fundamental truth. Rich is what you spend, but wealth is what you keep. What if the next market crash isn't a disaster, but the bill you pay to get rich? To protect your invisible wealth, you must fundamentally change how you view those terrifying red market days. Most investors see a market dip as a fine, a punishment for making a wrong financial move. They panic and pull their money out, effectively paying a penalty for a crime they didn't commit. But psychological programming tells us there is a much more powerful way to view this chaotic volatility. Instead of a fine, imagine market volatility is actually the admission price for the greatest show on earth. Think about your favorite theme park. You don't call the ticket price a fine for entering, do you? You happily pay that fee because you know the value of the experience waiting behind the front gates. In the world of investing, long-term compounding is that incredible ride, and volatility is your entry ticket. Every major dip is simply the market collecting its necessary fee for providing you with future financial freedom. When the charts turn red, your brain screams that your savings rate mastery is suddenly being threatened. However, this is precisely when the legendary power of compounding is testing your resolve and your patience. If you view the drop as a cost of doing business, you stop reacting with fear and panic. You realize that you cannot expect the massive rewards of index funds without paying the occasional price. This reframing allows you to stay calm while everyone else is running for the nearest exit door. Remember that those who refuse to pay the admission price never get to see the show's end. They stay outside the gates, safe from the drops but entirely disconnected from the path to wealth. Your psychological programming must accept that price as a feature of the system, not a broken bug. Every dollar of volatility you endure today is an investment in the invisible wealth of your future self. This perspective shift transforms a terrifying disaster into a routine transaction on your journey toward total freedom. Would you stop going to a world-class event just because there is an admission price at the gate? Market volatility is simply the mandatory admission price you must pay for those life-changing long-term returns. To reach the finish line, you must be willing to pay the volatility fee without flinching or folding. Because in the end, you simply cannot get the returns without being willing to pay the fee. Everything we have discussed so far leads us directly to this one final, inescapable truth. Wealth building is actually a psychological game that is cleverly disguised as a simple mathematical problem. While your spreadsheets focus on numbers, your brain is busy fighting decades of ancient biological programming. The math required to get rich is easy, but the discipline to execute it is incredibly rare. You must consistently perform basic arithmetic for 30 years while the rest of the world screams otherwise. Social pressure acts like a gravitational pull, trying to drag you back onto the hedonic treadmill. Can you truly stay the course when everyone around you is running in the opposite direction? We often mistake a high savings rate for a math equation instead of a battle of willpower. Choosing boring index funds is easy on paper, but psychologically taxing when markets begin to crash. This is where you pay the volatility fee we discussed, proving your resilience against your own fear. The true challenge isn't finding a complex shortcut, but surviving the agonizing boredom of compounding. Are you brave enough to remain invisible and boring while others flaunt their temporary, hollow riches? We must treat these 12 principles as a vital toolkit for your mind, not just your wallet. Think of finance as a grueling marathon where the crowd constantly begs you to stop or turn. Your logical side knows the path, but your emotional side wants to escape the perceived danger. Success comes when you finally stop acting like a logical robot and start managing your human flaws. Understanding your money means understanding the deep, hidden parts of your own complicated psychological makeup. You are now equipped to see past the jargon and focus on what actually moves the needle. The hardest part is simply doing the right thing when it feels like the hardest thing ever. Remember that this high-stakes game is not won on a calculator. It is won in your head. But rewiring your brain is always easier when you are not doing it alone on this journey. If these lessons changed your perspective, imagine what they could do for someone you know. Sharing these principles is like giving a friend a map out of a hidden maze. Who else in your life needs to hear that nobody is actually crazy with money? We are building a community of investors who value freedom over the flashy hedonic treadmill. Subscribe now to ensure you never miss a step in mastering your psychological programming. Hit the share button to help your inner circle escape the trap of invisible poverty. Together, we can stop the cycle of chasing status and start building truly invisible wealth. If you found value in these insights, like the video to help others find it. Financial freedom is not just about your bank account. It is about changing how everyone thinks. Are you ready to start your own 20-year clock toward true compounding success today? You now have the tools to view every market crash as a simple volatility fee. Helping others understand their savings rate is the greatest financial gift you can ever give. Imagine a world where people are no longer slaves to their primitive survival instincts. Make a commitment to your future self by joining us on this long-term path. Remember that your logical brain is now better equipped to handle any future financial punch. Break the chains of old thinking and step into a life defined by time-weighted freedom. Check the description for more resources to deepen your understanding of these 12 core principles. Spread the word and help us rewrite the rules of wealth for a new generation. Thank you for watching, and I will see you in the very next one.